The latest data is in, and it reveals a housing market that's on much shakier ground than you think. Forget what the mainstream news is telling you. While most analysts are busy projecting a flat market or a soft landing, they're missing the real story. They're telling you to watch interest rates and national home sales and to relax because a 2008-style crash isn't on the horizon. They might be right about that one specific scenario, but they're looking through the wrong end of the telescope.
A huge crash isn't the only way to lose your shirt in real estate. A significant, painful price correction can do the job just fine. And the indicators that actually predict these events are flashing bright red.
Everyone says to watch mortgage rates to know where home prices are going. That's a mistake. The real signals, the ones that have predicted major market shifts for decades, are sounding an alarm that gets louder every day. Right now, the ground is shifting under the market, and it has almost nothing to do with whether the 30-year fixed rate is 6.1% or 6.3%. We're going to cut through the noise and break down the 3 undeniable red flags that signal a major price correction is no longer a question of if, but when. And when is getting a lot closer than you think. But what exactly are these red flags, and why should you care? Let's dive in. Before we get to the red flags, we have to talk about the official story you're being sold. You'll hear from big names like Zillow, Redfin, and JP Morgan, and they'll all paint a picture of a calm, stable market. JP Morgan is calling for US house prices to completely stall at 0% growth in 2026. Zillow's projecting a tiny increase of just 0.9%, while Redfin is forecasting a 1% rise. They argue that a small bump in demand will be canceled out by a small bump in supply, leaving everything balanced. They're calling this the Great Housing Reset, a slow, steady return to normal. But here's the problem. That whole story is built on sand. It relies on a national average that hides serious weaknesses under the surface. Averages are dangerous. They smooth out the highs and lows and give you a false sense of security. It's like saying the average temperature of a hospital is 98.6 degrees. It tells you nothing about the patient in the ICU with a raging fever. The real story isn't a national average creeping up by 1%. It's about the pressure building inside the system and the fundamentals wearing away, which always happens right before a price correction. So, what's the first red flag that reveals this pressure? Let's find out. The first and most critical red flag is the total collapse of housing affordability. This isn't just a minor issue, it's a complete breakdown of the average American household's budget. For decades, a healthy housing market ran on a simple rule. Your home's price should be about 3 times your annual income. Today, that rule has been shattered. According to the National Association of Home Builders chief economist, the typical home now costs a mind-boggling 4.9 times the typical income. To put that in perspective, that's even higher than the 4.83 ratio we saw at the very peak of the 2005 housing bubble, right before the biggest crash in modern history. This isn't just a number, it's the math that proves the market is locked up. You'll hear the National Association of Realtors, NAR, say their housing affordability index has improved for the 7th straight month as of January 2026. But this is a classic case of misleading data. Yes, the index rose to 116.5, but what does that really mean? An index of 100 means a family with a median income has just enough money to qualify for a mortgage on a median-priced home. So 116.5 sounds pretty good, right? But what if I told you that this index is still historically low? Here's what they're not telling you. Before all the pandemic chaos, a healthy index was in the 150 to 170 range. We are nowhere near that. The improvement they're celebrating is like a patient's fever dropping from 105 to 103 degrees. Sure, it's better, but they are still seriously sick. The real measure of affordability is the chunk of your income that disappears every month just to cover your housing payment. The golden rule for generations has been the 28-36 rule. Spend no more than 28% of your gross monthly income on housing, and no more than 36% on all your debt combined. Today, millions of recent buyers have sprinted past those lines. At the peak, housing costs were eating up over 42% of the median household income. And even with so-called improvements, that number is still dangerously high in many places. Think about what this means for a real family. Let's say a household earns $80,000 a year. That's more than the median. Their gross monthly income is around $6,667. The 28% rule says their housing payment should be under $1,867. But with today's prices and rates, that payment is often closer to $2,500 or $3,000. That's not 28%, that's almost 45%. This family isn't building wealth, they're house poor, living paycheck to paycheck paycheck, one emergency away from financial disaster. This affordability crisis is shrinking the pool of qualified buyers. But what happens when fewer people can afford to buy? That leads us straight to the second red flag. The second red flag is that the power in the market has flipped from sellers to buyers, and it's happening faster than anyone is admitting. We're seeing sellers give in across the board. A wave of price cuts, weirdness in the new construction market, and more deals falling through. This isn't a balanced market. It's the start of a price correction. For years, sellers had all the power. They could list a house on Friday and have a dozen offers over asking by Sunday. That world is gone. The clearest sign is how many homes are getting their prices cut. Over a third of home builders cut prices in February 2026 to lure in buyers, and a whopping 65% are offering sales incentives, which are just price cuts in disguise. But what does this mean for the average seller? And this is where things get really interesting and dangerous for sellers. For the first time in recent memory, the median price of a resale home is now more expensive than a brand new one. Think about that. Builders have high costs for materials and labor, but they're still being forced to slash prices to move their inventory. Homeowners, on the other hand, have been stubbornly clinging to their peak 2022 prices, but they can't hold out forever. The NAHB's chief economist, Robert Dietz, said it clearly. He expects resale prices to fall in most markets in 2026 because they now have to compete with builders who are already cutting prices. It's a painful reality check for sellers. This is already happening. Realtor.com projects that home prices will drop in 22 of the 100 largest US cities in 2026, many in the South and West, where the pandemic building boom was the biggest. The flood of new homes in places like the Sun Belt is forcing everyone's hand. Beyond price cuts, other signs of seller distress are popping up. The number of homes for sale is climbing. Homes that once sold in a weekend now sit for weeks or months. Zillow data from January 2026 showed homes took a median of 47 days to go under contract, 8 days longer than the year before. When homes sit, sellers get nervous and cut prices. But what happens when that doesn't work? They pull their homes off the market, hoping for a better day that might not come. This gap between what sellers want and what buyers can afford has become a chasm, and it's a clear sign of a sick market. The third and final red flag is the most troubling because it shows the first real cracks in the financial foundation of the housing market. We're seeing a clear and accelerating rise in mortgage delinquencies, especially among the most vulnerable buyers. This is the first warning sign of forced sales down the line. Now, let's be clear, this isn't 2008. We aren't about to see a tidal wave of subprime defaults that takes down the whole banking system. Most homeowners have stable loans and a lot of equity. But to ignore the trend in delinquencies would be like ignoring the first tremor before an earthquake. The overall national delinquency rate for mortgages rose to 4.26% at the end of 2025, according to the Mortgage Bankers Association, MBA. While that seems small, the real danger is in the details. The rate was up from the last quarter and from a year ago, and the distress is heavily concentrated. The biggest and most alarming spike is in FHA loans. These are government-insured mortgages often used by first-time buyers and people with lower credit scores. The MBA's latest survey shows the delinquency rate for FHA loans has surged to an incredible 11.52%. That's the highest it's been since the second quarter of 2021. But why is this happening? Marina Walsh, an MBA vice president, pointed out that it's the later stage delinquencies, people who are 90 days or more behind, that have jumped significantly. A 30-day delinquency can happen for lots of reasons and often gets fixed, but being 90 days late is a sign of serious, ongoing financial trouble. It's the last stop before foreclosure. The rate of FHA loans that are seriously delinquent jumped by 106 basis points in just one quarter. Why is this happening? Walsh says it's tied to the end of pandemic relief programs and job losses hitting certain income levels, exactly the people who tend to use FHA loans. People bought homes at the peak, stretched their budgets to the breaking point, and now, with inflation still high and the job market weakening for them, they're falling behind. Each of these delinquencies is a future forced sale. A homeowner in foreclosure can't wait for a better price. The bank sells the home for whatever it can get. As these forced sales hit the market over the next year or so, they will add a steady stream of supply that will push prices down even further. But what does this mean for the overall market? Navigating this market means you have to see what others are missing. The story you're being told is meant to keep things calm, but the real data tells a different story. If you want to stay ahead of these trends and understand not just what is happening, but why it's happening, make sure you subscribe and hit that notification bell. I break down this data every week, giving you the unfiltered truth you won't get anywhere else. And let me ask you this, are you prepared for the potential fallout from these red flags? What steps are you taking to protect your investments? So let's put it all together. The mainstream story tells you not to worry, pointing to slightly lower mortgage rates and a flat market. But the three key indicators we've looked at tell a completely different story. First, the great affordability breach. With home prices at 4.9 times the median income, we're in more dangerous territory than the 2005 bubble peak. There just aren't enough people who can afford a home at today's prices to keep the market afloat. Second, the seller capitulation cascade. Price cuts are the new normal, especially as builders slash prices on new construction, forcing the resale market to follow. Realtor.com predicts price drops in 22 of the 100 biggest US cities this year. And third, the cracks in the foundation are showing. Delinquencies are rising, with a shocking 11.52% of all FHA loans now past due. This is the start of a wave of forced sales that will add supply to a market that can't handle it without dropping prices. These aren't old numbers, they're the flashing red lights on the dashboard warning of trouble ahead. While the consensus is calling for a soft landing, these signals point to a significant price correction in many parts of the country. This isn't about fear, it's about awareness. The 2026 housing market is not the time to be an amateur. It's a time to look past the headlines and understand the powerful forces at work. Stay vigilant, stay informed, and ask yourself, are you ready to navigate the storm?